All right, let's dive into gross profit margin today.
Okay. To really grasp its significance, we need to break down the formula.
Okay.
We take a company's revenue,
Okay.
subtract the cost of goods sold, which includes things like raw materials and direct labor,
Got it.
and then we divide that number by the revenue again. Finally, we multiply by 100 to express it as a percentage.
Okay, so it's pretty straightforward calculation then.
Yeah.
Why should we care about this?
Right.
Why do investors and analysts get so excited about this seemingly simple percentage?
It offers valuable insights into several key aspects of a business.
Okay.
For instance, it tells us about a company's profitability.
Okay.
Are they actually making money from their core operations?
Right, because a business can't survive on hype alone.
Right.
They need to be generating profit to grow and thrive.
Exactly. And beyond just making a profit,
Okay.
a healthy gross profit margin can indicate pricing power.
Okay.
Companies with strong margins often have the flexibility to raise prices without losing customers.
Okay.
Think about a luxury brand like, say, Gucci.
Okay.
They can charge a premium because their brand is associated with exclusivity and quality.
Yeah, they've got that brand recognition, right?
Yeah.
So it's not just about squeezing every penny out of each sale.
Right.
It's about having that cushion to adjust prices as needed.
Yeah.
Now, if we see a company with a lower gross profit margin, does that automatically mean they're in trouble?
Not necessarily.
Okay.
A lower margin could simply reflect their business model.
Okay.
Take a discount retailer like Walmart, for example.
Okay.
Their strategy revolves around offering the lowest prices possible.
Right.
They operate on razor-thin margins,
Okay.
but their massive volume of sales makes up for it.
That's fascinating.
Yeah.
It's like two sides of the same coin, right?
Exactly.
Both successful, but using completely different strategies.
Precisely. And that's why understanding context is so crucial.
Absolutely.
A good gross profit margin varies greatly depending on the industry
Right.
and the company's specific approach.
Got it.
Now, another key takeaway is that gross profit margin can also shed light on a company's operational efficiency.
Okay.
Are they managing their costs effectively?
Okay.
Or are there areas where they could be tighter?
Yeah. Are they running a tight ship or are they kind of wasting money?
Exactly.
Got it.
And while we often associate high margins with luxury goods or tech giants,
Sure.
there are other sectors where high margins are almost essential
Okay.
due to the nature of the business.
You're thinking of pharmaceuticals, right?
Yes,
I know drug development is incredibly expensive.
it is.
So I imagine those companies need a higher profit margin to offset those costs.
You hit the nail on the head.
Okay.
Companies like Pfizer invest heavily in research and development, clinical trials, and navigating regulatory hurdles.
Right.
Those high margins are vital for recouping their investments and funding future innovation.
So we've got profitability, pricing power, and operational efficiency.
Yeah.
What other clues can this magical margin reveal?
Well, it can also give us a glimpse into a company's competitive positioning.
Okay.
How do their margins stack up against their rivals?
Got it.
Are they leading the pack or struggling to keep up?
Okay.
This is particularly useful when comparing companies within the same industry.
That makes sense, comparing apples to apples. Or maybe we should say comparing iPhones to galaxies.
Exactly.
And finally, there's the question of scalability.
Yes.
Can a company grow its business without its margins shrinking?
Right.
This is where things can get really interesting, wouldn't you say?
Absolutely.
Yeah, I'm all ears.
Okay.
Tell me more about the scalability factor.
Well, imagine a company that's experiencing rapid growth.
Okay.
As they expand, they might need to invest in new facilities, hire more staff, or ramp up their marketing efforts.
Sure.
All of these things can impact their costs.
So even if their revenue is soaring, their margins could actually shrink
Exactly.
if their costs are rising at a faster pace.
Precisely.
Okay.
That's why it's not enough to simply look at revenue growth.
Got it.
We need to understand how that growth is impacting their profitability
Right.
and ultimately their gross profit margin.
This is getting really fascinating. So we've covered the formula, the why, and even got a glimpse into how different industries and business models approach gross profit margins.
Yeah. And to illustrate these concepts even further,
Okay.
we'll be diving deeper into some real-world examples,
Okay.
like Apple, Walmart, and Pfizer, to see how these factors play out in practice.
Oh, I can't wait to unpack those examples and see what we can uncover.
Yeah, should be good.
First up,
Okay.
the tech titan itself, Apple.
Apple is a fascinating case study.
It is.
They consistently maintain a gross profit margin
Okay.
between 35% and 40%,
Wow.
which is significantly higher than many other companies.
Sure.
This tells us a lot about their business strategy
Yep.
and their position in the market.
I've always been curious about how they manage to keep those margins so high. I mean, their products aren't exactly known for being budget-friendly.
That's true. Apple has cultivated an image of exclusivity and innovation,
Right.
which allows them to command premium prices.
Okay.
People are willing to pay a premium for the perceived quality, design,
Yeah.
and status associated with their products.
But it's not just about slapping a high price tag on their iPhones and MacBooks, is it?
No,
I've heard they have a super efficient supply chain, too.
you're absolutely right.
Okay.
Apple has mastered the art of supply chain management.
Okay.
They have a tight grip on their manufacturing processes,
Right.
leveraging economies of scale and negotiating favorable deals with suppliers.
It's mind-boggling how they manage to produce millions of devices
I know, it's incredible.
while keeping costs in check.
Yeah.
Isn't there a term for that?
Yes.
Vertical integration or something.
Yes. Apple's vertical integration is a key factor in their success.
Okay.
They control many aspects of the production process, from designing their own chips to owning their own retail stores.
What?
This gives them a level of control and efficiency that many other companies can only dream of.
So they're not just selling gadgets then, they're building an entire ecosystem.
Right.
Which, as we discussed, strengthens their pricing power even further.
Precisely.
Right.
And those high margins allow Apple to invest heavily in research and development,
Okay.
ensuring they stay at the forefront of innovation
Right.
and continue to release products that consumers crave.
It's a bit like a virtuous cycle then.
Is.
High margins fuel innovation, which in turn supports those high margins.
Exactly.
But not every company can be Apple, right?
Right.
Let's look at a company with a completely different approach. Walmart.
Walmart is a prime example of how a low gross profit margin can be part of a winning strategy.
Okay.
Their margins hover around 25%,
Okay.
which might seem low compared to Apple,
Sure.
but it's perfectly aligned with their business model.
Right. Walmart's whole shtick is everyday low prices.
Exactly.
And their massive scale allows them to make a profit even with those thin margins.
Yeah.
I read somewhere that they have more employees than the population of some countries.
It's incredible, and managing a workforce of that size efficiently is no small feat.
Right.
Walmart has optimized its operations to a remarkable degree.
Okay.
Their logistics, inventory management, and supplier relationships are all fine-tuned to squeeze every bit of efficiency out of their operations.
It's like a well-oiled machine.
It is.
Churning out products at incredibly low prices.
Yeah,
It's no wonder they're a retail giant.
for sure.
So we've got Apple with its high margins and Walmart with its low margins,
Right.
both incredibly successful.
Yeah.
What's the takeaway here?
The key takeaway is that there's no one-size-fits-all approach to gross profit margins.
Okay.
The ideal margin depends entirely on the company's overall strategy, the industry they're in,
Okay.
and their competitive landscape.
Got it. That makes sense.
Yeah. Now, for our final example, let's shift gears and explore a completely different industry. Pharmaceuticals.
I'm curious to hear more about how companies like Pfizer navigate this world of high research costs
Right.
and intense competition.
The pharmaceutical industry is truly unique.
It is.
Pfizer, as you mentioned, typically enjoys gross profit margins in the 70% to 80% range,
Wow.
which is significantly higher than most other sectors.
That's a huge difference.
Yeah.
I knew drug development was expensive, but I didn't realize the margins were that high.
Yeah.
Why is that?
It all comes down to the nature of their business.
Okay.
Developing new drugs is an incredibly complex and costly process. It involves years of research, rigorous clinical trials,
Okay.
and navigating a maze of regulatory hurdles.
It's a high-stakes game.
It is.
I imagine not every drug makes it through the pipeline.
Right.
So those successful drugs need to generate substantial profits to cover the costs of those that don't.
Exactly. And once a drug is approved,
Okay.
companies obtain patents that grant them exclusive rights to sell that drug for a certain period. These patents are crucial because they provide a temporary monopoly,
Right?
allowing them to recoup their massive R&D investments and generate those high margins.
So it's a high-risk, high-reward scenario.
It is.
But even with patents, they eventually face competition from generics, right?
That's right.
Okay.
Once a patent expires, other companies can produce and sell generic versions of the drug,
Right.
typically at much lower prices.
Makes sense.
This is why pharmaceutical companies are constantly racing to develop new drugs and secure new patents.
So they can keep those high margins going.
Exactly.
Got it.
It's an ongoing cycle of innovation and competition.
So those high margins are essential not just for profitability,
Right.
but for funding the next wave of research
Yeah,
and staying ahead in this dynamic industry.
for sure.
Now, we've seen how these margins play out in different companies and industries,
Yes.
but how do we analyze these numbers effectively?
Right.
It can't just be about comparing one company's margin to another, can it?
You're right. Context is key.
Okay.
We need to go beyond just looking at the raw numbers and understand the story behind those margins.
Okay.
This involves analyzing trends over time, comparing companies within the same industry,
Okay.
and even considering external factors that might be influencing profitability.
Okay, let's break that down.
Okay.
What do you mean by analyzing trends over time?
It's about looking at how a company's gross profit margin has been changing over a period of time.
Okay.
Is it trending upwards, indicating improving profitability?
Okay.
Or is it declining, which might signal potential issues?
So if a company that has historically enjoyed high margins
Right.
suddenly sees those margins start to shrink, that could be a red flag worth investigating.
Exactly.
Okay.
It could indicate increased competition, rising input costs, or problems with their pricing strategy.
Makes sense.
It's a signal to dig deeper and understand what's driving those changes.
And when we're comparing companies within the same industry,
Right.
it's not just about looking for the highest margin.
Oh.
We need to consider their different business models and strategies.
Absolutely.
Right.
A luxury car manufacturer will naturally have a higher gross profit margin than a budget-friendly car maker.
Makes sense.
The key is to understand the industry benchmarks and compare companies with similar business models.
So it's about comparing apples to apples, or in this case,
Right.
BMWs to Toyotas.
Exactly.
And what about those external factors you mentioned?
Right.
How can those impact a company's margins?
Well, think about something like inflation.
Okay.
If a company's input costs are rising due to inflation,
Okay.
but they're unable to raise their prices accordingly, their margins will inevitably be squeezed.
Or consider supply chain disruptions.
Right.
We've seen how those can wreak havoc on businesses,
Right.
driving up costs and impacting profitability.
Yes.
So it's not just about what's happening internally then,
No.
but also about understanding the broader economic and geopolitical landscape.
Precisely.
Right.
Analyzing gross profit margins effectively is a multifaceted process.
It requires considering historical trends, industry benchmarks,
Right.
and the broader context in which a company operates. What are some red flags
Right.
that listeners should be on the lookout for when analyzing gross profit margins?
Oh,
What are the warning signs that something might be amiss?
a consistently declining gross profit margin is certainly a red flag,
Okay.
especially if it's not accompanied by a clear strategic shift.
Okay.
Like Walmart's focus on low prices.
Right.
It could indicate intensifying competition, rising costs, or problems with pricing power.
And what about a company whose margins are significantly different from their industry peers?
Okay.
Does that always mean trouble?
Not necessarily.
Okay.
There might be legitimate reasons for a company to have higher or lower margins than its competitors.
Okay.
Perhaps they have a unique business model, a superior supply chain,
Right.
or a strong brand that allows them to command premium prices.
But if a company's margins are significantly lower than their peers and there's no clear explanation, that could be a sign of underlying problems.
Exactly.
Okay.
It could indicate inefficiencies, weaker pricing power, or other competitive disadvantages.
Got it.
And another red flag to watch out for is volatility in gross profit margins. Wild swings from quarter to quarter
Yeah.
can be a sign of instability or vulnerability to external shocks.
So it's not just about the absolute number.
Well,
It's about understanding the context, the trends, and the potential warning signs.
precisely.
Right.
Gross profit margin is a valuable tool,
Okay.
but it's just one piece of the puzzle.
Right.
We need to use it in conjunction with other financial metrics
Okay.
and qualitative factors like management strength and brand reputation
Got it.
and the broader economic and industry landscape.
Okay. We've covered a lot of ground here.
We have.
From the formula to real-world examples
Right.
to analyzing trends and warning signs.
Yeah.
But before we wrap up this deep dive,
Okay.
I want to leave our listeners with a final thought-provoking question. Imagine you're looking at two companies in the same industry.
Right.
One has a consistently high gross profit margin,
Okay.
while the other has a lower but steadily growing margin.
Okay.
So as I was saying, imagine you're looking at two companies in the same industry. One has a consistently high gross profit margin, while the other one has a lower but steadily growing margin. Which one would you be more interested in, and why?
That's a fantastic question. Uh, it's not as simple as just going for the highest margin, right? We need to think about the story behind those numbers.
Okay, let's play investor for a moment. What kind of stories would we be looking for?
Well, for the company with the consistently high margin, we'd want to ask,
Hmm.
is it sustainable?
Okay.
Are they maintaining those margins by innovating? Or are they simply benefiting from a lack of competition?
Right.
Could new entrants disrupt their position and potentially squeeze their margins in the future?
So a high margin isn't always a guarantee of future success.
Exactly.
Okay, what about the company with the lower but growing margin? What would make them a tempting investment?
That steady growth could be a sign of positive momentum.
Okay.
Perhaps they're becoming more efficient, gaining pricing power, or tapping into new markets.
Right.
Maybe they've implemented cost-saving measures or streamlined their operations.
It's like they're on an upward trajectory,
Right.
constantly improving their profitability.
Exactly.
That could be incredibly appealing to investors,
It is.
even if their current margin isn't as impressive as the high flyer.
Exactly. Sometimes that upward trajectory can be more attractive than a static high margin, especially if there are questions about the sustainability of that high margin.
So it's not just about the snapshot of where they are now.
Right.
It's about their potential for future growth and profitability.
Exactly.
We need to look beyond the static numbers
Yep.
and understand the forces driving those numbers.
It's about understanding the dynamics at play and making informed decisions based on your assessment of the company's long-term prospects.
This has been such an eye-opening deep dive. We've demystified gross profit margin, explored its real-world applications, and even played investor for a bit.
We did. We did.
But before we wrap things up, are there any final nuggets of wisdom you'd like to share with our listener?
Um, I'd say the biggest takeaway is to remember that gross profit margin, while a powerful metric, it's just one piece of the puzzle.
Okay.
It's essential to consider other financial metrics,
Right.
qualitative factors
Yeah.
like management strength and brand reputation, and the broader economic and industry landscape.
Don't just blindly chase the highest margin then.
No.
Understand the context, analyze the trends, and consider the bigger picture.
Yeah,
It's about using all the tools at your disposal to make informed investment decisions.
absolutely.
Right.
And remember, knowledge is power. The more you understand about financial metric like gross profit margin, the better equipped you'll be to navigate the complex world of business and investing.
Well said. I think our listener is well equipped to start analyzing those margins like a pro. So the next time you're researching a company or listening to an earnings call, don't just glance at the financials. Dive deep into that gross profit margin. You might be surprised by what you uncover. Happy analyzing, everyone.